Act at the altar of mathematics, Greenwich, Connecticut. 1994. To the casual observer, the office at 1010 Washington Boulevard looked like any other high-end corporate suit. But inside, a group of men believed they had discovered the fire of the gods. They weren't just bankers, they were the high priests of a new religion, the religion of the model. John Merriweather, the mastermind of the group, was a man of quiet, intense charisma. At Salomon Brothers, he had led the arbitrage group, a band of traders who treated the bond market like a private casino where they held all the aces. But Merriweather wanted more. He wanted to build a firm that was purely cerebral, a place where gut feeling was considered a relic of a primitive past. To do this, he didn't just hire traders. He hired the architecture of modern economic thought. He recruited Robert Merton and Marin Scholes. These were names that students in every MBA program in the world whispered with reverence. They were the creators of the Black-Scholes-Merton model, the formula that allowed the world to put a price on risk. For the first time in human history, someone had provided a mathematical bridge between the present and the uncertain future. In 1997, they would be awarded the Nobel Prize in Economics for this work. At Long-Term Capital Management, or LUTM, they weren't just consultants, they were partners. They were there to prove that their equations weren't just academic theory, they were a license to print money. The pitch to investors was irresistible: we are smarter than the market. And the world believed them. They raised over $125 billion in initial capital, the largest launch in the history of the hedge fund industry. The list of partners read like a who's who of the financial elite. Even central bankers from other nations invested their personal wealth. They weren't betting on a fund, they were betting on the human mind's ability to conquer chaos. Act A, the architecture of the trade. How did they do it? To understand the fall, we must understand the elegant machine they built. The strategy was something called relative value arbitrage. In a world of trillions of transactions, small discrepancies occasionally appear. Perhaps a 10-year Italian government bond is selling for a fraction of a percent less than it should compared to a German bond. In the eyes of a normal trader, this spread of 0-1 is noise. It's invisible. It's not worth the phone call to execute the trade. But to the geniuses at LUTM, that tiny gap was an invitation. They believed that, like a law of physics, prices that are out of alignment must eventually return to their historical relationship. This was the convergence. Like a rubber band stretched thin, the market might pull them apart for a while, but it must eventually snap back. However, there was a fundamental problem. Picking up a fraction of a penny is not how you build an empire. To turn these microscopic wins into the 40 annual returns they promised, they needed a massive multiplier. They needed leverage. In the mid-90s, the banking world was awash in liquidity and desperate to be in business with the Nobel Prize winners. Banks like Morgan, Bear Stearns, and Goldman Sachs competed to lend LUTM money on terms that were, quite frankly, insane. They allowed LUTM to borrow with zero collateral in many cases. They gave them haircuts of zero. By 1998, LUTM had about $4-7 billion in actual equity. But they had borrowed enough to hold positions worth over $125 billion. That is a leverage ratio of roughly 25-1. But that was just the on-balance sheet number. If you included their complex derivative contracts, their bets on interest rates, stock volatility, and foreign exchange, the notional value of their trades was over $1-2 trillion. To put that in perspective, that was more than the entire gross domestic product of many developed nations at the time. They had built a mountain of debt on a tiny foundation of cash, all because their models told them that the mountain was physically incapable of falling. Act A, the shattered mirror. For nearly 4 years, the machine worked perfectly. The partners became fabulously wealthy. They were the masters of the universe, looking down on the dumb money of Wall Street. But in 1997, the first cracks appeared in the global mirror. The Asian financial crisis began in Thailand and ripped through Indonesia, Korea, and Malaysia. Suddenly, the historical correlations that Merton and Scholes relied on began to wobble. Markets that were supposed to move together began to move apart. The models at LUTM signaled that this was a once-in-a-lifetime buying opportunity. The market is being irrational, they reasoned. Therefore, we should bet even bigger on its return to sanity. They doubled down. They tripled down. They used their remaining capital to suck up every cheap spread they could find. Then came August 17, 1998. The Russian Federation, teetering on the edge of economic collapse, did something that the LUTM models considered a 12 sigma event, an event so rare that it shouldn't happen in the lifetime of the universe. Russia defaulted on its domestic debt and devalued the ruble. In an instant, the world went into a state of flight to quality. Investors didn't care about math. They didn't care about relative value. They were terrified. They sold everything that had even a hint of risk and poured their money into US Treasury bonds. In the LTM models, when the world panics, different types of bonds are supposed to move in a way that hedges each other. But on that day, everything LTM owned went down, and everything they had bet against went up. The rubber band didn't snap back. It snapped. In a single day, August 21, 1998, the fund lost $550 million. By the end of August, they had lost nearly $2 billion of their capital. The impenetrable fortress was being breached, not by a rival army, but by the cold, hard reality of human panic. Active the liquidity black hole. As September dawned, the situation turned from a disaster into a nightmare. LTM was now a wounded whale in a sea full of sharks. On Wall Street, word had leaked that the geniuses were in trouble. And in the brutal logic of finance, if you know a giant is forced to sell, you don't help them, you sell before they do. Every major bank that had been LTM's partner weeks ago was now inadvertently or intentionally trading against them. This created a liquidity black hole. LTM needed to sell its positions to raise cash and pay back its loans. But because their positions were so gargantuan, the moment they tried to sell, the price would collapse. They were too big to exit the building. They were the market itself. John Merriweather spent his days on the phone, desperately trying to raise capital from Warren Buffett, from George Soros, from any billionaire who would listen. But the numbers were too frightening. By mid-September, the equity of the fund, which had been nearly $5 billion at the start of the year, had shriveled to less than $600 million. And they still had over $100 billion in debt. But the danger wasn't just to the partners of LTM. Because they were so deeply interconnected with every major bank, their collapse would trigger a cross-default nightmare. If LTM couldn't pay Goldman Sachs, Goldman might not be able to pay its other counterparties. Like a line of falling dominoes, the entire global payment system was 48 hours away from a total freeze. The Federal Reserve Bank of New York realized that this wasn't just a hedge fund dying. This was the threat of a second Great Depression. Act of the room where it happened, September 22, 1998. The most powerful men in finance were summoned to a wood-paneled room at the New York Fed. The atmosphere was grim. These were men who hated each other, men who competed for every dollar, now told they had to save their most arrogant rival. William McDonough, the president of the NY Fed, didn't mince words. He told the CEOs of Merrill Lynch, Morgan Stanley and others that a chaotic bankruptcy of LTM would be a systemic catastrophe. The meeting was a masterclass in tension. At one point, a group of banks offered a deal, but it was rejected by others. Tensions flared. There were rumors that Warren Buffett had made a shark bid to buy the whole fund for pennies on the dollar, but a technicality in the LTM contracts prevented it. Finally, after a weekend of grueling negotiations, a deal was struck. 14 banks would contribute a total of $625 billion. In exchange, they would take 90 of the fund's equity and the right to slowly wind it down. The geniuses were out. The banks were in charge. The market opened on Monday, and the world breathed a sigh of relief. The immediate threat of a global meltdown had been averted by a private sector bailout. But the scars would remain forever. The myth of the perfect model had been dragged through the mud and left for dead. Act by the autopsy of arrogance. What is the true legacy of long-term capital management? When we look back at the wreckage, the error seems obvious. The partners at LTM committed the ultimate sin of the intellectual. They confused the map with the territory. They believed that because their equations were beautiful, the world was obligated to follow them. Robert Merton and Myron Scholes had built a model based on the normal distribution, the famous bell curve. In that world, extreme events like the Russian default are so statistically rare they can be ignored. But the financial markets are not a bell curve. They are a fat tail environment. In the real world, impossible things happen every decade. The geniuses forgot that a model is only as good as its assumptions. They assumed that markets are liquid. They assumed that participants are rational. And most importantly, they assumed that the future would always look like a slightly varied version of the past. But history is not a circle, it is a jagged line of unforeseen shocks. After the bailout, Merriweather tried to start another fund. It failed. Merton and Scholes returned to academia and other ventures, their Nobel Prizes slightly tarnished by the shadow of 1998. The banks that saved them eventually went on to create even more complex instruments, leading directly to the great financial crisis of 2008. We are often told that risk is something we can calculate, hedge, and eliminate. But LTM teaches us that the greatest risk is the one you haven't thought of. It's the unknown unknown. The tragedy of LTM wasn't a lack of intelligence. It was a lack of humility. They had enough brilliance to see the patterns in the stars, but not enough wisdom to see the storm clouds gathering on the horizon. As we move further into the age of artificial intelligence and algorithmic trading, the ghosts of Lutum are more relevant than ever. We once again find ourselves trusting black box systems that we don't fully understand, built on the certainty of data. But data has no memory of fear. And when fear returns to the market as it always does, no equation in the world can stop the stampede. In the end, the most dangerous thing you can be in a room full of money is the smartest person in the room. Because once you believe you have solved the game has already won.